Hello everyone, welcome back to another episode of Multifamily with Veena Jetti. Thank you so much, Veena, for coming today.
Yay, thank you for having me.
And today we're going to talk about the economic cycle. So first of all, when it comes to recession, tell us about recession and how does that have an effect on multifamily?
Yeah, I think recessions have an effect on every industry, right? And so we always want to be cognizant of them because we want to know how it's going to affect our investment. Our tenants going to be able to continue paying rent if there's a recession. And so we want to make sure that when we know we're looming at the horizon of a recession, that we have the ability to withstand any kind of turbulence or storm that might come as a result of that. So when we enter our assets or when we go into our assets, we want to make sure that we're making more conservative assumptions, especially at this part of the market cycle, because we have to assume a certain number of tenants are going to lose jobs or going to be making less money. And so we want to take that into account as we're planning when we're going into our assets.
What are some of the strategies that you and your team have implemented in order to shield your assets from these?
So one of the biggest ones is increasing the amount of cash reserves we have. So now we have more cash on hand than we might have had a year, 2 years, 5 years ago. We maintain cash reserves. Two, we are leveraging assets less than we used to before. So anytime you have lower leverage on assets, you're automatically restabilizing the asset. So today we might be leveraging to, oh gosh, I don't even want to say it because it's so painful, but we might be leveraging to like 55% on some of our assets, or even less in some cases. But it's okay because even though we're generating lesser returns for our equity investment, which is the cash infusion, we are still maintaining stability across the assets so we can operate through any kind of a down cycle or recessionary cycle.
So tell us, Veena, you mentioned that you guys are leveraging your assets less than before. Yes. So what is leverage and how is your involvement with all your assets?
So when we talk about leverage, we're talking about the amount of bank loan or first lien, senior debt, mortgage. All of those are kind of interchangeable terms, at least in this scenario that we're talking about. And so when we're leveraging our assets today, we might be leveraging them as low as 55%. And I know someone who hasn't done this before might be like, okay, that sounds fine. But it's really not, because just like 8 months ago, we could leverage to like 65%. And 12 months ago, 18 months ago, we could leverage to 70, 75%. So you have to remember though, with less leverage, there's less risk in the deal. But your LP equity, which is the 45% on the other side of that, your LP equity is going to get a little bit of a lower return, but they're more stabilized in the assets. So it's a trade-off.
Gotcha. And that is in the case of a recession, but as in any other economic cycle, we also go from the recession into the recovery period. Right now, we're facing a little bit of a recession, but after this first stage, I guess, we're going to go into a recovery. So what is a recovery period within multifamily?
Yeah, I think a lot of people worry a lot about market cycles. And, I get asked all the time, are you acquiring during a recession? Yes, we buy and we sell at all points in the market cycle, because if we don't, we're not operating our business half the time we're open, right?
Right.
So what happens is our strategy changes. So when we are in a recessionary period, that's actually where we try to acquire more, because we're going to get assets at really great pricing. We're going to get really great deals. Hopefully there will be more opportunity for us to buy at a higher cap rate potentially. And then what we'll do is we'll continue to hold it and operate it and hopefully optimize it in that time period, so that by the time the recovery period or the top of the market comes back around, we can start selling off those assets. So we want to buy low, sell high. I know it's like very revolutionary concept, but in real estate and in multifamily, it's absolutely cyclical, and we have the ability to do that even more so with value add multifamily, because we're forcing the appreciation. So we're forcing that value to grow in the period of time where there is a recession. So one of the major changes you'll probably see outside of leverage is our assets. Maybe we would have held them on, historically we've held about 3 years and 3 months, but now we might hold 4 or 5 years to see how far through the cycle we can get, or we might re-leverage, pull investor capital out, and then maintain the asset for the next few years through the hold period. It depends on each asset and what the business plan is. But generally speaking, there's a lot of ways to move through a recession. It shouldn't scare anybody. It should actually excite you, because as an investor, I'm excited for the opportunities that are about to come. In a bull market, everybody made money. In bear markets, that's where real money is made, right? That's
where millionaires are made.
That's where millionaires and billionaires are made, is in a bear market, not a bull market.
And it's interesting that you pointed out that you are willing to and ready also to invest in any sort of market, any sort of the economic cycle as well. Because you do have the strategies placed so that way you can protect your assets and on top of that even make more income.
Exactly.
Now let's move on to the next stage of the economic cycle, which is the growth period. So what is the growth period and how does that reflect on multifamily?
Yeah, I think we've seen a major growth period, which was ironic. I don't think a lot of us were expecting that through COVID, but we did see that. And in multifamily, that's when we see cap rates compress significantly lower than we usually anticipate. It was right before the yield curve inverting that we saw cap rates continue to compress. And then now we're starting to see them expand a little bit with interest rates going up, right? As the Fed continues to increase the interest rate, we're seeing the cap rate increase slightly as well. So as that starts to expand, that's where we're seeing kind of the other side. We're over the hump of the growth period of the market.
And during the growth period of the market, what do you think is the best strategy that we should be using?
Yeah, I think in the growth period, this is where you want to sell a lot of assets that you bought in the down cycle. This year alone, we exited, I think, 7 assets we sold. So we sold off a lot of our portfolio. A lot of people would be like, oh, what's your AUM right now? And I'm like, pretty much almost 0 because we sold everything. But it was great because our investors made a lot of money in us selling those assets. So knowing when to sell them is also important in this part of the market cycle. And so I think that's really key too, as you're looking at your portfolio and as you're managing it, to know where you are in the market cycle and what your plan is at each part of the market cycle.
And the cool thing is that within multifamily, since it's real estate, multifamily, you can always have a strategy for that.
Absolutely.
Like if the market is going down, you know what you have to do. If prices for houses are a little bit lower, then you know also what you have to do. If renters are trying to buy houses and now they have more power to actually do so, then you also know what to do.
Absolutely.
And now let's go on to the next stage of the economic cycle, which is maturation. Or maturity in this case. So what are some of the strategies that your team implements during this stage?
Yeah, so this is really growth and maturity are kind of in the same bucket, if you will, because maturity is when your asset has kind of come to its final stages. Like there's no more value add for us to actually execute on, or maybe we've reached the end of our business plan and our business plan has matured. So that's where you want to look at what your exit options are. So there's a lot of different ways to exit any asset, and you always want to have multiple exit plans in place. But more importantly, you want to be able to know going into the asset who your exit is to. So who are you selling it to? Are you selling it to other syndicators? Are you selling it to family offices? Are you selling it to institutional funds? It really depends on what your asset looks like, what you've implemented to it, who can buy it from you. For example, sometimes you might go in and say, hey, we're only going to renovate 30% of the asset, prove out the business model, and then sell it to the next investor so that they can renovate 70%, or maybe they do 40% and then leave the remaining 30%. So real estate is cyclical in that way, and just from like a market cycle perspective. And so you want to make sure you really understand who your exit is to when your asset does reach maturity or your business plan does reach maturity.
And it's always because you're always tracking every single detail on how the performance of your assets are going, and also how the market is going as well.
Exactly.
Thank you so much again, Veena. And thank you to our audience. So there you have it. Stay in tune with every single area and aspect of the performance of your buildings, your assets, to make sure that it's the right time for you to implement the right strategy. We're going to see you on the next episode. Bye-bye.